fantastic to have you on ET Now. Thank you for joining us. Were you in India 2 weeks ago?
It was more like 4.
A friend of mine actually told me you're in India, so next time I look forward to see you in our ET Now studio.
I would love to go there. Thank you.
I'll look forward to that. Mark, what should we expect from Fed later this week? Complete surrender to panic and inflation, and they are going to be forced to increase interest rates by 100 bips?
Well, there's certainly a lot to look forward to because not only will they be raising rates, that's a given. So we want to see how much they raise rates, but they'll also be updating their dot plot, which shows the forecasts of the Fed officials for Fed funds rate longer term. As far as the actual increase on Wednesday goes, I would say that the delivery of it is as important as the number. And what I mean by that is, let's say they raise by 100 basis points. If they deliver that in the context of a message that we think we're beating inflation, the worst is behind us, that would ironically be a dovish 100 basis points. On the other hand, they could increase by 75 basis points and deliver a very hawkish message, oh, there's still a lot to worry about, and the market wouldn't like it. So I think that the tone of the delivery, the statement, and the subsequent press meeting will be very important. But my sense is that whether it's 75 or 100, they're not going to come out and say, oh, by the way, the world is in terrible shape. So I think that probably we're going to get a bit of a rally after the meeting.
So whether it is 75 or 100, you expect markets to rally?
I do, actually, because I don't think they're going to be delivering an extremely hawkish message this time. And one of the reasons for that, I might add, is that one of the key inflation inputs that the Federal Reserve uses is the University of Michigan's long run inflation expectations. The survey for September was released on Friday, and it showed that those expectations are now back to where they were in July last year. So that, I think, is an important number. And by the way, the Wall Street Journal journalist who covers the Federal Reserve, he tweeted that that was a good number to see. And he's often thought to be kind of an unofficial mouthpiece of the Federal Reserve.
Okay. Just wondering though, Mark, as to what's going to happen to India, considering we've fallen a lot less amidst the global peers. We fell only about 1.6% in the week gone by and less than 3.5% from the September 15 highs. Having said that, the FIIs have been selling India, but again, the quantum has not been as high as some of the other emerging market peers. You think this outperformance is going to continue, Mark?
Yes, I think it will, because the economy is doing very well, and it's a domestic economy, unlike in North Asia, where Japan, Korea, Taiwan, so much of their economies are predicated on exports, particularly technology, which looks very soft right now. Korean DRAM exports were down 25% in August over August last year, just as an example. And they started running very big trade deficits, which is surprising for those countries. So on a relative basis, India, with its big domestic economy, I think looks in good shape. And I wouldn't have said that if foreigners had been huge buyers over the last few years. You know, that's what happened in the run-up to the global financial crisis. Why was the Nifty such a terrible market in 2008? It fell even more than the S&P 500, because foreigners had already been buying tons and tons of it in 2005, 2006, 2007. But it hasn't been like that this time. They don't have a lot to sell. In fact, I would see them as being more buyers, especially if the dollar starts to top out.
Okay, that's the view coming in on the overall liquidity position right now. What is the outlook as well, Mark, when it comes to some of the commodity producers, owing to the way we are seeing things shape up globally, the acute volatility within global commodities? What's your outlook back home?
The problem is that we have not in almost any of our lifetimes experienced inflation at this level in the Western world. I mean, you'd have to be in your 80s, really, to have had a career that included inflation running at the levels that it's at. And I don't think many people in their 80s are still working today. So none of us really know this big bogeyman inflation. We know it's peaked and it's coming down, but where is it coming down to? Is it coming down to 2% or 3 or 4 or 5 or 6? And that's the $1 million question, because based on that, we'll know what interest rates are. And for now, the answer isn't clear. So what I'd say to answer your question about commodities is that I would keep some exposure in commodities, because I actually don't think inflation will come back down to 1 or 2%. I think it'll probably be, closer to, let's say, the 4% level. And in that case, you want to hedge against inflation. Commodities offer the best hedge. So that's what I think about that.
Mark, why is gold not going higher? The easiest and the obvious hedge is buy gold, biggest hedge against inflation. Inflation, like you said, highest ever, at least both of us have seen in a lifetime. And gold prices are on a different orbit altogether. Are we missing on some basics of economics here?
I've been scratching my head about gold for a long time, and I've concluded that it's because of a generational transition in the ownership of wealth and the deployment of wealth into investing. And what I mean by that is, and I ask every single young person I know, the young people don't like gold. And I guess I'm talking more about the zillennials, in other words, people aged around 20, in their mid-20s or below. But even for the people in their 30s, I don't think I've met a single one who likes gold. And the fact is that in most countries, certainly including India, these younger people are now the largest percent of the population. And by the end of this decade, they will have the assets. They will be running. There'll be senior politicians. There'll be senior people in the corporate community, and they'll have a lot of money because the baby boomers and the Generation X will have passed off their wealth to them. And all I can say is that for reasons I don't entirely understand, they don't like gold. I base that purely on my own anecdotal survey that I've been sort of doing for about a year now. As I say, I haven't met a single one who told me they like gold. So that, I think, is the problem.
Okay, Mark Mathews, great to have you on the show. Thank you so much for taking the time out and speaking with us today.